Legends, welcome back to the Forex program. What we're going to get into in this lesson is a little bit more of an interesting video, thank God. So you've sort of gotten through setting yourself up, understanding MetaTrader, trading view, what makes a good broker, what makes a bad broker, all that sort of stuff. So you're pretty much set up and ready to get stuck into it. Now, what we're going to do is we're not jumping straight onto the charts. We got to go through this part first because you need to sort of understand what the asset class is that you're actually participating in. So what is the foreign exchange market? A little bit of a backstory and how it actually all started, so you have a good understanding of the market that you're participating in, right? A lot of retail traders, they skip this section, and I think it's super important. I wish I knew this sort of information when I first started trading too, because I'm just like most people, I skipped this part. And it wasn't until I was a little bit older that I realized that this is so important to understand early on in trading. Now, if you haven't learned this yet, that's perfectly fine because you are about to. So let's get stuck into it. So what is the foreign exchange market? So essentially, it's a decentralized global marketplace where currencies are bought and they're also sold. So it has the most trading volume on a daily basis and is the most liquid financial market in the world. So it has an average of over $5 trillion worth of volume, liquidity, that goes through it every single day. A lot of people say, oh, it's 6 trillion or 6.6 or 7 trillion or whatever. I don't have an exact number simply because I don't want to be that specific because it varies. But I do know that it's over $5 trillion worth of volume per day. So it's a lot. Exchange rates in the foreign exchange market are determined by supply and demand. So the more buyers there are, market's probably going to go up, and the more sellers there are, market's probably going to go down, vice versa. But we're going to get into those sorts of things later in future videos. I want to keep it quite basic for now. But there are a lot of factors that actually influence the exchange rate of different currencies. And some of them include economic indicators, geopolitical events, central bank policies, interest rates, which is one of the economic indicators, and market sentiment. And we're going to get into all of those things in future videos as well, so stay tuned. And those fluctuations in those exchange rates create awesome opportunities for us traders to profit from currency price movements. And that's why I find it so important to understand these things to be a profitable trader. You need to understand what actually influences the value of an asset so you can capitalize on it. If you're just using a technical analysis, I feel like you're missing out on a lot of the bigger picture. Not saying technical analysis is bad. I'm just saying you're missing out on a big chunk. And having even a basic understanding of fundamentals will help you so much in your trading. I truly believe that. So let's get into the next slide. So the history of the FX market. Let's get into some history. A lot of you guys are like, yuck, this is disgusting. But we got to do it. So the Forex trading originated in the 19th century, primarily conducted by banks, corporations, and governments for trade and investment, quite stock standard. In the early 20th century, major financial institutions dominated with stability provided by the golden standard and the Bretton Woods Agreement. We're going to get into those in the next slides as well. So the creation of the Bretton Woods system in July of 1944, delegates from the 44 nations gathered in Bretton Woods, New Hampshire. I probably pronounced that wrong, but we're going to keep rolling, to design a new international monetary system. This meeting led to the creation of the International Monetary Fund. You've probably seen that little abbreviated term a little bit, IMF. So that is what it stands for, the International Monetary Fund, and laid the groundwork of the future World Bank Group. The currency convertibility system established at Bretton Woods remained in effect until 1971. But in August of 1971, US President Richard Nixon announced a temporary suspension of the dollar's convertibility into gold. And this decision came in response to the dollar's decline throughout the 1960s. within the established Bretton Woods parity. So the crisis ultimately resulted in the breakdown of the Bretton Woods system. A little bit of history there. These sort of facts, like, they're not, a make or break in your trading success, but they're really important for you to understand and to have that overall perspective of how the FX market started, concepts behind it, and also just understanding the FX market as a whole. Moving on to that, in the 1970s and 1980s, we sort of transitioned to the digital world. And in the 1970s, that's when it shifted in forex with the collapse of the Bretton Woods system, which we talked about in the previous slide, leading to floating exchange rates. And this is where in 1980, they introduced electronic trading systems. This is where it started to get a little bit more spicy in the retail trading market as well. Increasing efficiency, reducing costs, and opening new opportunities for global traders and investors, mainly huge institutions. So the start of retail trading in the 1990s. So obviously technology and regulatory changes allowed for retail traders to access forex trading a lot easier. So online brokers provided user-friendly platforms, democratizing forex trading and enabling individual investors to participate. So ECNs is a digital system that matches buyers and sellers. They offered transparency and competitive pricing for retail traders. And that's sort of when retail trading started to really boom. And, when you hear people say that they just trade trend lines, they just trade support and resistance, all of those real easy stock standard strategies, they were really effective during this time, late 90s, early 2000s, until people started to trade it more. And there was a lot of people trading the same strategy. And if any of you guys know what alpha decay is, it's not a good thing for strategy. So those strategies became less and less effective over time. And obviously now you're most likely going to be unprofitable if you're just trading trend lines. And the people that say that they do just trade trend lines alone, yeah, a bit sus. So next slide, global impact of forex trading. And we're getting into the early 2000s now, but we saw an increased global participation in the 24-hour forex market. Algorithmic trading and high frequency trading firms enhanced efficiency and liquidity, solidifying forex as the world's largest financial market. That's sort of when institutions started to go ham on high frequency trading. And obviously back then it was more like 70% of major institutions were trading on a proprietary basis, and most of it was actually manually traded. So real people were actually trading. There were more professional traders making financial decisions and investment decisions. Whereas to now, only 20%, 30% is real people actually placing positions. And, for most investment banks like Goldman Sachs, for example, they only trade about 30% on a proprietary basis. But most of the professional traders, they're just managing the systems, the technology, making sure that there's no inefficiencies, and the algorithms and the technology is doing most of the work. They're just essentially there to make sure that it doesn't break. Whereas hedge funds, it's a little bit different. They trade much more on a proprietary basis, and there are a lot more professional traders that actually, make investment decisions. But again, high frequency trading and algorithmic trading is a lot more popular now than it once was. The rise of mobile trading in the 2010s. So this is sort of when, trading apps started to become a little bit more popular as well and accessible, offering traders convenience and flexibility to trade on the go. Absolutely wonderful. It's good for us, but it's also really good for brokers and institutions, market makers that make a shit ton of money from people, just whipping up their phone and placing positions, thinking that they can be super profitable because it's easily accessible. and obviously they lose money, the market makers make much more money. So there's more people participating because it's easily accessible. Whereas, if you're just trading on your computer, it's going to be a little bit harder. It's not as accessible. It stops people from, actually participating in the forex market. So social trading platforms enabled knowledge sharing, and stricter regulations ensured fair trading practices and transparency for retail traders. The next one, so the digital revolution, which is now in the 2020s, forex trading continues to evolve with blockchain technology, cryptocurrencies, AI, and machine learning, sort of what we were talking about before. And sustainable and ethical trading practices are gaining importance, reflecting a growing awareness of financial markets' global impact. Forex trading remains adaptable, innovative, and resilient. So what I'm sort of talking about at the end there is you need to stay open-minded, you need to be adaptable, you need to continuously learn. I think that's one of the most important things in your trading career, is to make sure that you're open-minded and you're learning new things every single day. Your self-development is super important. Never get naive and cocky and think that you're the best trader in the world just because you're profitable. Just because you're profitable now doesn't mean you will be in 5 years from now, because who knows when your strategy becomes less effective. You're going to have to change certain characteristics about your strategy. You're going to have to evolve and adapt over time with the market and the current technology as well. So I think that's really important, and that pretty much sums it up. So what we're going to get into in the next video is market makers. That's where it starts to get a lot more spicier. I hope this provides a little bit more context into what the FX market actually is, and sort of that whole backstory, how it started in the transition over time to the current FX market. So I hope you all enjoyed, and I will see you on the next video. Thanks, guys.